Good morning, traders. This is Evelyn from Astra Montis, and I'm here to bring you the latest insights for the week of May 20th to May 25th, 2024. Let's dive into what to expect in the upcoming week. This report examines the latest economic indicators and monetary policy expectations of major global economies, countries and regions including Canada, the UK, Japan, the US, New Zealand, and the Eurozone are dealing with their respective inflation challenges and the implications for monetary policy. These economic data and policy decisions will significantly impact global financial markets. Inflationary pressures in Canada appear to be easing again after the downward trend in various CPI metrics stabilized in the latter half of 2023. Key indicators, CPI trim, median, and common, decreased for the third consecutive month in March. Although the headline rate rose slightly to 2.8%, it is not considered alarming. And wage growth has also moderated since the start of the year. The Bank of Canada will meet on June 5th with a roughly 40% chance of a 25 basis point cut. A softer than expected April CPI report could increase those odds to 50%, even with continued progress in controlling inflation. A rate cut is more likely in July. For the Canadian dollar, weaker inflation data could disrupt its one-month uptrend against the US dollar. However, in the broader context, expectations of Fed rate cuts will play a more significant role in determining the loonie's trajectory. The UK will release its inflation statistics on Wednesday. Headlines CPI fell to 3.2% in March, the lowest since September 2021. Core CPI also showed an encouraging decline in early 2023, and April is expected to continue this trend. The headline rate is projected to drop to around the Bank of England's target of 2.0%, largely due to changes in the energy price cap. Policymakers remain cautious about inflation potentially rising again once this base effect diminishes. However, hints from the BOE suggest interest rates could be cut this summer. Investors are increasingly betting on a June cut, with odds just over 50%. There will be another CPI report before the June policy meeting, and if it aligns with expectations, the BOE may not wait until August to lower rates. However, rapid economic recovery and improving consumer confidence may limit the scope for significant rate cuts, especially with persistent wage pressures. Thursday's flash PM is for May, and Friday's retail sales data will be crucial in supporting the narrative of rebound and growth. A brighter outlook could sustain the pound's rebound against the US dollar, provided the Fed is also expected to cut rates soon. In Japan, lower inflation is expected when the April report is released on Friday. Core CPI fell from 2.8% to 2.6% in March and is forecast to drop to 2.2% in April. An inflation rate near to 0.0%, combined with shrinking GDP, would make it difficult for the Bank of Japan to raise interest rates soon. Investors expect the BOE to hike by at least another 20 bps in 2024, but not before September. Thursday's flash PM might show a more positive economic outlook. However, this is unlikely to convince investors of imminent rate hikes. The yen's recent bounce will depend on the dollar's performance. In the United States, economic data releases this week include existing home sales Wednesday, new home sales Thursday, and durable goods orders Friday. Additionally, Thursday's PMI surveys will be analyzed for signs of economic slowdown or moderating input costs. Despite a lighter data schedule, Fed rate cut expectations will dominate focus. The minutes from the May policy meeting will be released on Wednesday, and several FOMC officials are expected to speak, offering updated views. Policymakers have maintained a hawkish stance since the recent CPI report. If this higher-for-longer rhetoric continues next week, the US dollar might recover some recent losses and yields could increase. However, for equities, sustained hawkish Fed talks could hinder Wall Street's attempts to reach new record highs. The Reserve Bank of New Zealand, RBNZ, will make a policy decision next week. Although inflation has been gradually declining, it has not fallen as quickly as desired. Concerns about persistent non-tradable inflation mean the RBNZ is unlikely to signal a rate cut soon, keeping the cash rate at 5.50% on Wednesday. There is a slight chance the RBNZ may bring forward its projected rate cut from the second quarter of 2025 to the first quarter or earlier, which could be seen as a dovish move. However, even with potential downward revisions, the New Zealand dollar may see some future bullish corrections, as market expectations are currently for a rate cut starting in October. The Euro area will focus on the flash PM is released on Thursday. Forecasts suggest slight increases in both services and manufacturing PM is for May, with the composite PMI rising further above 50.0. The Eurozone exited a shallow recession in Q1, and growth may accelerate in the coming months, while a June rate cut seems certain. Stronger than expected PMI data could boost the euro by reducing the likelihood of further ECB rate cuts beyond June. Conversely, weaker PM might hinder the euro's recovery against the dollar, as deeper rate cuts are priced in by investors. In summary, major economies are experiencing varying inflation trends and economic challenges. Canada and the UK are on pause to ease inflation, though the direction of their monetary policies remains uncertain. Japan faces low inflation and economic contraction, while the US continues to focus on inflation data and Fed policy moves. New Zealand and the Eurozone are also dealing with their own inflation pressures and economic recovery situations. Economic data over the coming months will further clarify the policy directions of these countries and regions, impacting the trajectory of global markets. To conclude, as we navigate through this week's trading landscape, it's essential to closely monitor these significant updates. We appreciate your confidence in our insights and wish you prosperous trading in the days ahead.